We're going to now talk about the BBB. I can't bring myself to actually say the tax bill that you are all aware of, but there are some very particular changes that have happened that you should be aware of in relationship to both 2025's filings and perhaps more importantly, preparing yourself in 2026. Um, and I'm delighted to have Jeff Audi with us here this morning. Jeff is, for some of you know, has been out on family leave caring for twins, and he's very happy to get back to work, according to what he said just recently, because the twins are lovely, but it's always nice to come back to work. And we certainly are delighted to have him back. So, Jeff, I'll hand it off.
Thanks, Max. Thank you for having me first and foremost.
Of
And
course.
it's so good to see so many familiar, friendly faces and familiar names too. Yeah, it's great to have you all here and to have this moment. Hey, Beth. Um, okay. Well, there's a number of topics that I want to go through today. I could spend the next week talking about the BBB. I also won't name it. But I've kind of hand selected the top topics that I think will be most applicable for our larger client base. And the ones that we've fielded the most questions about, the tax advisors at Chicory, myself, Brad, Keith, and Sam, we've already fielded a ton of questions on OBBB. And these are the things that have come up most frequently. By all means, if there's questions, as you know, Max and I discuss these topics, throw them in the chat box or definitely save your questions, email us afterwards. We definitely want to get you the answers. All right, Max, the first thing I want to discuss is uh, the enlarged standard deductions, including the new senior deduction, the bonus senior deduction. We've gotten so many questions on this. Um, okay, so for 2025 tax returns, the tax returns we're going to be filing in the coming months, the standard deductions have increased. If you are a single taxpayer, you get an automatic deduction of $15,750. If you're over 65 as of the last day of the tax year, so December 21st, 2025, and you're single, you get to add $1,950 to that. And if you're over 65 as of the last day of the tax year and you're single, you potentially get to add a $6,000 bonus senior deduction. Now, I say potentially there, and we'll come back to that in 1 second. For married folks, you get that automatic $31,500. If both spouses are over 65, you get another $3,100, $1,550 for each spouse. And then potentially, if both spouses are over 65, you each get an extra $6,000 bonus senior deduction. So an extra $12,000 deduction. Potentially. That third piece is potentially. And that's what you have to keep in mind. So the potentially comes into effect because there's income limits. In order to qualify for that bonus senior deduction, if you're single, 6,000, or if you're married and both spouses over 65, 12,000, your income has to come below certain limits. So if you're single, you have to make $75,000 or less. And if you're married, you have to make $150,000 or less. Now, it's not a cliff. It's not if you are single and you make $75,001, you're entitled to nothing. Or if you're married and you make $150,001, you're entitled to nothing. There's a phase out. So the phase out for that $6,000 deduction is 75 grand of adjusted gross income to 175 grand if you're single. And if you're married, $150,000 to $350,000. So your senior deduction kind of dwindles as you move through the phase out. And then once you're at the upper level of the phase out, you get none of that extra deduction. But this is extremely powerful because if you think about it, if you're married and you're over 65 and you and your spouse have an adjusted gross income of less than $150,000, you get a total deduction of $46,600. So that means you're essentially shielding $46,600 from income tax completely on your 2025 tax return. So it's an extremely large deduction, something like we've never seen before. Um, and you're right. The 2025 is done. So this will be reflected on your 2025 tax return. But as we move through 2026, there's a lot of things to keep in mind surrounding this because this law that's enhanced senior bonus deduction applies for tax years 2025 through 2028. So we still have a number of years to go. So there's things to keep in mind. You might not want to take as much money out of your IRA, for example, if you have a large cash balance somewhere and you can use those funds rather than triggering taxable income by taking an IRA distribution. Or maybe you have highly appreciated securities, securities that are worth a lot more than when you purchased them back in the day. Maybe you want to be very cognizant about how much how many of those securities you're selling throughout the course of the year in a non-qualified, non-retirement brokerage account, a taxable account, because that will trigger taxable income and get you closer to those income limits for the senior deduction. Maybe you're over 65 and still working. A lot of our clients are still working as they're, in their heading towards retirement over 65. Maybe you want to start deferring income instead of recognizing all of your income in 1 year. Maybe you can work with certain clients if you're self-employed or your employer even to defer income, spread it out over tax years so you don't hit those upper income limits. And
Doesn't it
disqualify
strike you
yourself.
interesting? It's interesting that this all ends in 2028, huh? Oh, well,
Hmm.
never mind. Okay, go ahead.
Yes, that is. Thank you for pointing that out, Max. That is,
I'm sorry, I'm going to try and keep my political commentary to myself, but the tax code talks. The tax
yeah,
code tells a story, right? Keep going.
highly suspicious. I totally agree with that. Um, Yeah, so I mean, those are kind of like the planning tips surrounding that, and that's kind of the logistics of how it works. We are certainly doing this for y'all as we are, recommending Roth conversions, for example, strategically moving money from your traditional IRA to your Roth IRA, which is there's many positives to doing so, but we're thinking about it for those clients that are close to this income limit because we don't want to, rip you of a $12,000 deduction unnecessarily. We're thinking about all of these things throughout the years. We're performing our tax planning analyses and making recommendations to you. So yeah, the enhanced senior deduction, huge. One of the biggest changes. Um, Okay, I'll move on to a second big topic here. Um,
Question before you move on. Yeah, I
sure.
actually had this question too. Is the senior 6,000 per person independent of whether you itemize or take the standard deduction? There's that. Yeah.
Yep. Yep. So yes, you can actually take it even if you take the standard deduction. It's on top of your itemized deductions or your standard deduction. So either way you go, as long as your income limit is under the threshold, you're able to take it. That's a great question, Jim.
And Jeff, obviously, even if only one spouse is over 65, you at least get the 6K if you're under the income limit, right? You can
That's
get
right.
up to a
Yep.
maximum of 12.
Up to a maximum of 12. If one spouse is over 65 and one is not, and your income's under the limit, you still get 6,000. Absolutely. Great question. Okay, let's move on to the second topic. Keep the questions coming as I'm talking. I'll pause between topics to kind of glance at the questions and address them. Um, I'm sure most of you have heard about this, the increased SALT deduction. So, what does SALT stand for? It stands for state and local taxes. So, this deduction will come into play if you itemize. So, unlike the senior deduction, you need to itemize your deductions. You can't take the standard deduction to benefit from this. So, what does it mean to itemize? It means that very simply, the mortgage interest that you pay throughout the year, if you own your house and you have a mortgage on it, your charitable contributions that you make throughout the year, and your state and local taxes, both real estate taxes and state income taxes that you pay to the Georgia Department of Revenue or whatever state you live in, if those items cumulatively exceed your standard deduction amount, you will itemize your deductions on your tax return because it's beneficial to do so. You get a larger bang for your buck. If those three items cumulatively do not exceed your standard deduction, you will just take the standard deduction because it's in your favor to do that. But what this SALT deduction increase means is that third bucket. So on top of your mortgage interest, on top of your charitable contributions, this third bucket of state and local income taxes, previously, you were only able to deduct $10,000 worth. If you paid more than $10,000 towards your property taxes and your state income taxes, too bad, so sad, that deduction was lost. But now you can deduct up to $40,000 in state and local taxes, as long as your income is under $500,000, regardless of your filing status. So single taxpayers, married taxpayers, does not matter. As long as you make less than $500,000, you're able to deduct up to $40,000 in state and local taxes to count towards your itemized deductions. So it's not the case that, oh, I always take the standard deduction. I'm not even going to provide my tax account and my charitable donations or my mortgage interest or, my small real estate tax bill. It's not the case anymore because this deduction is so large, moving from $10,000 to $40,000, there's a good chance that you will itemize your deduction. So if we prepare your taxes in-house, we will crunch the numbers for you. And we definitely will request all of that information for you, and we will do what's beneficial on your tax return. But it's basically just something to keep in mind as you're filing your 2025 through 2028 tax returns. Yeah, there we go again, Max. There's the 2028 sunset. And also, too, with this deduction, one of the things I didn't mention is you need to make under $500,000 to qualify for the full $40,000. But there's also a phase out for this deduction as well. The phase out is $500,000 of income to $600,000 of income. If you make over $600,000, you're only left with the $10,000 deduction, the old one. But if you make between $500,000 and $600,000, there's a 30% reduction. So for every dollar of income into the phase out range, your $40,000 deduction reduces by 30 cents. 30% reduction there. Yeah. Any questions on that enhanced SALT limit? All right. I'm going to head into the third topic. But if anything comes up, definitely shoot it in the chat. All right, Max, this is the third topic I wanted to discuss today, the new car loan interest deduction. So back in the day, and Max and I were just talking about this, you could deduct your car loan interest. You could deduct your credit card interest. You could deduct all sorts of interest. But in recent years, you've only been allowed to deduct your mortgage interest. So they're bringing this back here, the car loan interest deduction. And there's actually a number of requirements to be able to deduct the interest on your car loan. Again, this is for 2025 to 2028. It's a maximum deduction of $10,000 per year, but there's a number of requirements to be able to meet eligibility for it. The car loan must have been entered into after December 31st, 2024. So it has to be a 2025 or newer car loan. The vehicle must be new. It can't be used. So for those of you like me that purchase used vehicles, you won't be able to take this deduction. The vehicle must weigh less than 14,000 pounds. Final assembly of the vehicle must occur in the United States. You must have a loan on the vehicle. There has to be a lien on it. And leases do not qualify. But if you meet all of those requirements and your income is under a certain limit, if you make less than $1,000 single or $200,000 married, you are able to deduct the interest paid on your car loan throughout the year. And there's actually a new tax form that you might see. You might get issued a 1098 VLI. VLI stands for Vehicle Loan Interest. And obviously, your car loan servicer doesn't know your income levels. So you might get this 1098 VLI and make too much for the deduction. So it might be of no moment, but you might see this being issued by your car loan servicer. And if you get it, that's what that is. It's just reporting the interest that you paid on your loan over the course of the year. Um, and the same with the other items that we talked about. There's a phase out. So if you are single, the phase out is from $100,000 of income to $150,000 of income. And if you're married, the phase out is $200,000 of income to $300,000 of income before you're not allowed any of your car loan interest on your tax return. It is an above the line deduction, meaning you can take the standard deduction and make use of it. You can itemize your deductions and make use of it. It's above the line. It does not matter if you itemize or not. And so now, a bigger picture, financing versus paying cash for a car, it's now partly a tax decision. Um, Max and I were also talking about this recently. We don't want to let the tax tail wag the dog. You don't want to enter into a car loan, a depreciating asset, and have a loan on something that's going to be worth less and less and less just to be able to get a tax deduction.
Yeah, never
Um,
do that. It's
right.
all about the rate. It's all about, I've had people say, oh, I should go get a mortgage. I'm like, at rates where they are now? Definitely not. Definitely not. And at rates where, I mean, I'm sure I haven't looked at car loan rates of late, but they're not where they were. And somebody asked me about, oh, maybe it was you, Jeff. What about, 2.99? And I was like, well, understand what you figure out what you're financing because car dealers aren't giving you free money without taking more money from you. They're probably probably a higher price for the car to begin with. So don't rush out and buy a car. And you just got to think about these income limits. It's like, did somebody just stand with a dartboard and like throw something? It's like, why that and not, why aren't they consistent? It's just, every time in the past I would try and explain anything about the tax code to anybody. Doesn't it make you just sound like people will just be like, you got to be making this up, right? This is crazy. Why is it like that? It's bizarre. Anyhow.
Keeping the income limit straight in my head has been,
Oh, Lord.
yes.
Can't even imagine. I mean, you better have a big, yeah, right? Exactly. Yeah.
Yeah.
Anyhow.
So definitely talk to your financial advisor if you're thinking about entering into a car loan.
Yeah.
Uh, However, just know that this deduction does exist. And if you meet all of those criteria that I mentioned, that I listed out, definitely keep an eye out for that tax form or request it from your loan servicer. Um, okay.
We had a question in the chat, Jeff, going back to donations. Isn't there a renewal of a modest credit for donations, whether you itemize or not, in 2025?
That is also true, Jim. Um, in 2025, moving forward now, even if you don't itemize, so even if your mortgage interest, charitable contributions collectively, and state and local taxes don't exceed your standard deduction. So even if you do take the standard deduction, you are able to deduct a modest amount of charitable contributions above the line separately on your tax return. That amount is $1,000 if you're single or up to $2,000 if you're married. And you're right, it is a renewal, Jim, because back in the days of COVID, that's when I remember it most recently. It was $300, I think, if you were single, or $600 if you were married. That even if you took the standard deduction, you could make use of some of your charitable contributions. But now it's $1,000 single, $2,000 married. So another reminder: make sure to give your tax accountant your charitable contribution information, even if you know you're not going to itemize, because those two small deductions might apply for you. Yeah,
Right. Right.
great question.
It all adds up.
Yep.
Oh, but only until 2028.
That's right.
And then
Pending
who knows?
additional legislation. Yes. um,
Yikes.
There's a few other minor topics I wanted to, call out. Um, those of you with kids or potentially with grandkids, there was an increase to the child tax credit. So if your child who is claimed as a dependent on your tax return is under age 17 as of the last day of the tax year, the child tax credit has increased from $2,000 to $2,200 per child. Um, Additional income limits here: $200,000 single or $400,000 married. I don't think we've heard those limits yet today. Um,
Bingo.
and yeah, so that's also something to keep in mind. There's a little bump there. Um, 529 plans, there was a change to 529 plan withdrawals. Previously, you could only take out $10,000 a year to pay for K through 12 education. Now you can take up to excuse me, $20,000 per year. So it went from 10 grand to 20 grand. And the what those funds can be utilized for expanded greatly. It can be used for tuition at public, private, religious schools, tutoring, academic instruction, standardized testing, so SATs, ACTs, those sorts of exams, educational therapies, educational materials such as textbooks, a whole slew of things now 529 plan funds can be used for. So definitely, if you have kids or grandkids that are in K through 12 and you're wanting to use some of your funds tax free in your 529 plan, there's more flexibility surrounding that for sure. Um, we've been talking a lot about income tax, but quickly I want to talk about. Oh, Sarah, you had a question here. Oh, so did you,
Is there
Jim.
guidance somewhere on the recent changes to 529 plans?
Yes, I will. I can actually send that to you, Sarah. I can definitely find some really good guidance on that. And let's see, you're welcome. And Jim,
Foster
okay.
parents qualify too.
Yes, that is
Child tax
true.
credit. Hmm.
Yep,
Right,
definitely.
right.
That's right.
It's a credit too, which is more powerful than a deduction.
That's
Immediately
right.
offsets taxes. Credits are
On a
few and far
dollar for
between.
dollar
Dollar for
basis.
dollar. Right, right,
Yeah, the credits are definitely better.
right.
Um, okay, gift and estate. There's been little changes to gift and estate tax consequences that I wanted to go through. For 2025 and 2026, the gift tax limit is $19,000, which means you can give up to $19,000 to any individual and not have to file a gift tax return. Does not need to get reported anywhere. If you gave more than $19,000 to an individual, or if you're married and you collectively gave more than $38,000 to any individual during 2025, or if you do so during 2026, you will need to file a gift tax return. It's essentially an informational return, no taxes due with the filing, but you need to tell the IRS, hey, I gave this individual more than the limit for the year. And what happens in that scenario, when you do file a gift tax return, is it reduces how much you're allowed to give over your lifetime and at death tax free. So any amount over 19,000 will reduce your lifetime exemption, but the lifetime exemptions have exploded. They're now $15,000 if you're
15
single.
million. 15
15
million.
million, thank you. 15 million if you're single, or 30 million if you're married. So it's very hard. It's very hard to reach that. You got to be extremely wealthy and extremely generous before that comes into play. So for most of our clients, we just keep in mind that the limit for gift tax returns being filed is $19,000. Um, okay, let's see. Oh,
There's
okay.
a yeah point made by Eric just that some states have not adopted these updated 529 rules relative to K through 12. I don't know
Mhm.
about Georgia. I just asked him if he knows about Georgia. If they've
Yeah, that's a great point, Eric. Thank you. So the rules we're discussing are all federal rules. Some states will not, they'll choose to diverge from the federal rules. They'll say, that's great that the IRS is doing that, but we're still going to let you only take $10,000 out of your 529 plan. If you take more than that, it's going to be considered an add back on your tax return. So if a state has diverged from the federal rules, for example, and you take $15,000 out of your 529 plan, there might be an add back on your state tax return, an extra $5,000 that shows up as taxable. That's what Eric is referencing
But
there.
only for the state. The Fed's going to allow it.
Yep,
Gosh, that
only on your
reminds me
state
of
tax
gay
return.
marriage. Yeah, okay. It depends on the state you're
Yeah.
in. Nice.
um,
Okay.
okay. Couple other things. Some housekeeping items. In 2026, so 2025 tax returns that we're filing in 2026, the IRS has done away with paper checks. You cannot receive your refund via paper check any longer. You must receive your refund via direct deposit. So you need to provide your tax accountant your bank information of choice if you're expecting a refund. That's a change that was implemented. Um, as of now, payments to the IRS. So if you owe money with your tax return, you're still able to do that via check or via direct debit or online at, on the IRS website. You're able to still do that electronically or by check, but not for long.
Hmm.
So I think it's best practice to just get into the zone of all money going in or out should be done electronically.
Hmm.
Um, but yeah, if you're due a refund from the IRS, you can't get a paper check any longer. Um, let's see. Oh, okay, Max. One of the things I wanted to talk about were, or at least mention, was Trump accounts. These new Trump accounts for kids. I know, how dare I say that term, but I do want to mention it quickly. Um, so some of you on the call might have heard of these new Trump accounts for children. It's basically a government-seeded investment account for kids. It will be seeded with $1,000 of money. That's the initial deposit. It's meant to encourage early wealth building for children. Um, that's the idea behind it. And kids born between 2025 and 2028 with a valid social security number will be eligible for these types of accounts. The way you open up these accounts, basically, there's a form that's filed with your tax return, or you have the option to go online and elect an account be opened. But there's many red flags, and Max and I both discussed this recently as well. Yeah, so I'll highlight a few of the things that gave us pause, so to speak. Um, it is a Treasury selected financial institution. You can't choose the custodian. You can't move the money. They are in charge of where the money will sit and live. And that might change in the future, but they've given us no guidance in terms of when that will occur, how that will occur, what choices you will have. It is all up to the government. Um, there's only
What could
broad.
possibly go wrong?
What
Sorry.
could possibly go wrong there? Yeah. Um, only broad US stock index funds are allowed. So no bonds, no cash, no target date glide path. There is 100% equity risk. So there's very little flexibility in terms of investment choices. So as kids grow up and they're getting closer to using the money, you think you would want to make the account a little bit more conservative, but it will remain risky pending any changes to the law. The risk tolerance on these accounts will be huge. You have to have a huge risk tolerance to be comfortable with that. 100% equity risk. So something else that we didn't love about it. Um, and there's just a lot that's unknown. We're not sure at this point how the contribution limit will interact with other IRA contribution limits, meaning if you contribute the most that you're allowed to this account, which is $5,000, I don't think I mentioned that annually, will that take away from how much you're able to contribute to other IRA accounts. Um, the guidance is not clear on that either. So, all this to say, there's a number of other red flags. All this to say, we have made the decision at Chicory Wealth that we feel that there's better planning tools available. Other accounts that are known, that have been around for many years, that have very easy to follow, non mysterious rules. So, we have also taken the stance that we will not be electing, generally speaking, we will not be doing a blanket election for any clients with children born during 2025 to 2028, filing that election form on 2025 tax returns to open the account. Um, it's just not something that we can recommend and support at this time. That said, if there are one-off situations where clients are, very interested in opening the account, and we've documented the risks, we've made you aware of the risks, and the red flag, so to speak. We're happy to support you, and we're happy to file the form on your behalf, and we're happy to work with you and do, what you would like to do. But we can't do it in good conscience without at least talking to you about it first.
We need to know
Um,
more. Yeah.
yeah, we
Yeah.
just need to know more first.
I mean,
There's too many.
notably, like even large custodians like today, I just remember Trump University, Trump steaks, meme coins. There's Fidelity, to my knowledge, hasn't come out with any rulemaking on this or anything either. I mean, and they're a very, very large custodian that would, so we just don't know. It's not clear. We did the research on that. It's not clear.
Yeah.
This is
Fidelity's website is very vague, Max. I was actually
is
just
it?
on it earlier
It's because they
reading.
don't know either. Yeah.
Exactly. And at the bottom of the Trump account page, it says, oh, and don't forget you have all these other accounts to utilize as
Which you
well.
could,
So they're even promoting,
right.
yeah,
It's a
UTMA account,
529. It's a
the
Roth
Roth IRA
IRA. Yeah.
account.
I have no
So they're
account.
even
Yeah.
promoting all of those accounts.
Yeah.
So they're kind of like staying up with the times and telling you what they know, but at the same time, I don't even think they're recommending it at this point.
Yeah. I don't think yeah. Yeah.
Yeah.
This is an interesting comment from Sarah. Georgia also has a new quote catastrophic, I think is what catastrophic savings account with some tax advantages. Is this like how to save for your next climate change disaster, the inevitable climate change disaster? Is that the heart of it? Have you heard of this, Jeff? I haven't heard of
I have
this.
not heard of this. So now I
Okay.
I owe Sarah two follow-ups here. I owe
Okay,
her
Sarah, thank
the
you.
catastrophe savings account information, and then also the 529 plan guidance as well. Thank you for surfacing that, Sarah, because it's good for
Right.
me to know. I have not heard that caveat.
Oh, here it
Thank
is.
you.
Disaster savings accounts. Okay. There it is, 12:15. Thank you. We'll check it out and see what we can find out about that.
Certainly.
Yikes. Yeah. We don't have a climate problem. But if we did, it's good to save for that. I'm sorry. It's just crazy. What do we know when it'll be time to get our new IRS PIN for the year?
Yeah, Linda, you should be able to log into your IRS account and it should be available. The IRS e-file platform opens up on January 26th to start accepting personal tax returns for the 2025 tax year. I don't think anybody will be have everything together by January 26th to file. But in order to do so, they need to make the IP pins available, the identity protection pins available. So if it's not there yet, Linda, I would go in on January 26th and I bet it will be there.
Thank you. You rock.
Yeah,
And Jeff, on that note, in terms of housekeeping items for when people for whom we do taxes can expect to see things in their inbox and that, do you want to hit some of that? Go ahead.
definitely. So our tax portal invites, those have started going out. The first ones went out as early as Sunday, a couple days ago, and they will be going out in waves throughout the week. If you don't have it by end of day Friday, please let us know, and we can work with you to recover it, to find it, try a different method to get it to you. We'll definitely be your IT help desk, because strange things happen with it.
Yeah, yeah.
But yeah,
Spam.
so this week, Max, that's a great question. And
Okay.
again, the tax portal allows you to do three things: sign your tax return engagement letter, answer a brief tax questionnaire, and then also upload your 2025 tax documents. So keep an eye out for that if we prepare your taxes. And then the only other thing to keep in mind is our information submission deadlines. So if we prepare your personal tax return or your trust tax return, our information submission deadline is March 1st, 2026. If you're able to get us your information by March 1st, we should be able to file your taxes by the April 15th due date. If we don't have substantially all of your information by March 1st, there's a chance that we might need to extend your tax return. We'll do our best, but there's a chance. We can't promise after that date.
Right. Don't
And then for business,
procrastinate. It doesn't get better,
yeah,
people. It never gets
don't
better.
procrastinate.
Just do it. Just do it.
And if we file your business tax return, our information submission deadline is February 15th, 2026, just because that due date is a month earlier. It's March 15th. So we need the information a little bit sooner as well.
Right.
Yeah.
Um, Jim, up in North Carolina, he's a volunteer and has been for years, and he does tax prep for lower income families, some of whom who do not have bank accounts. Any insights into what those, I mean, not that anybody in Washington cares about them, but let's just imagine somebody did. Like, how would they get their money?
Yeah, it's a
Target
great
gift
question.
cards,
Well,
you know,
you joke about it, Max, but actually I've seen prepaid prepaid cards being sent out to folks. I'm
okay.
not too familiar with the process just because our client base on average
Yeah,
is
obviously. Yeah.
not lower income,
Yeah.
but so most folks do have a bank account. But yes, Jim, I believe that there's a way to request a prepaid card, like a Visa card or MasterCard with the tax return if you're not electing direct deposit with bank information.
Okay.
Yeah.
Got it. Okay. Let's see. Wait a minute. One more, just a thanks. Okay. Other questions before we wrap it today of any kind? Any questions at all? All right. Jeff, we good?
Yeah,
Got
thank
it
you
covered.
everyone for listening
Okay.
to my spiel. And
It's excellent.
yeah, I'm looking forward to preparing a lot of your tax returns in the coming months.